Are low interest rates here to stay? Let's have a look. Hello everyone, I'm Florian Heise and welcome to another episode of Heise Says. I thought we'd look at this analysis today. This is to do with the record low interest rates that we have here in Australia. Frankly, the insanely low interest rates that we have here in Australia. And really it shines a spotlight on the reduced effectiveness of monetary policy. The closer we get to zero, the less effective it's going to be. I wonder if these predicted negative interest rates are going to be more effective than lower interest rates. Because I guess if you're being penalized, you might be more encouraged to spend. Or will that cause a run on the banks? I don't know. Let's have a look at this article. So record low interest rates are here to stay and may even sink lower, economists predict. So I wonder if David Taylor, who's the business reporter writing this on the ABC, is going to delve into the theoretical negative interest rates. You get the sense from economists that the global economy is in deep trouble, but nobody quite knows how to fix it. Yeah, that's a good point. That is a good point. Just dwelling on that with my Stein. Sometimes things need to go through natural cycles, and maybe it's all coming to a head. For their part, major global investment banks are now forecasting record low interest rates as far as the eye can see. We're living in an extraordinary time at the moment, Queensland Investment Corporation's Beverly Morris said. It's in keeping with the sentiment at a meeting of central bankers, including Australian Reserve Bank Governors Philip Lowe in the US during the weekend, where they struggled with ideas to sandbag the global economy from the escalating US-China trade war. What we're seeing is markets and policymakers across the globe grappling with monetary policy towards the end of its useful life, but also unexpected and unexplainable political developments just make it so much more difficult for everyone, she said. Well, there's some interesting points. So is it the point that, we're at the end of the useful life of modern monetary policy? Is the Chicago school coming to an end? What will the future hold? Will we all start adopting the Austrian economic school? Why not? I'd vote for it. There have been many gobsmacking moments on global financial markets this year, but a German auction of 30-year bonds captures the main market fear to a degree. The government issued a bond which only offered to give investors their money back and nothing more in 30 years' time. Wait, what? Okay. Damn, that's worrying right there. That's worrying. Many big investors took up the offer. What does that tell you? Would you lock your money for 30 years for nothing? Just to get it back? I guess that's less risk than holding it in a bank where you get negative interest, less risk than anything else. What does that tell you? That investors are doing that. What does that tell you? Deutsche Bank Australia's chief economist, Philip O'Donoghue, concedes he has never seen anything like it in his career. I mean, it's just inconceivable to think that over 30 years you're not going to see a positive rate of inflation, he said. Implicitly, theoretically, that is what that 824 million euros, the amount of demand in the bond auction, is assuming. I mean, it's just extraordinary. It just doesn't seem... It's just not... It is giving no signs of confidence in the future. No signs at all. And I need another coffee on that. There is a heavy focus on the ups and downs of interest rates of global long-term bonds because they are seen by economists as a throw forward to what Australians can expect to pay on their interest rates years from now. Global Bank HSBC research team has forecast what the interest rate on a 10-year US Treasury bond will be in 2025. HSBC Australia chief economist Paul Bloxham told PM that amazingly it is expected to be lower than what it is today. If the rest of the world is going to have even lower interest rates, it's very hard for Australia not to have to follow that path. And I think that's what we're looking at in terms of what's going to drive the RBA to potentially have to cut further. I mean, cut further. Look here. Does that mean cut further down here? Because what were we reading? Negative interest rate to 6% during the last GFC. There you go. They dropped there to there, or the cash rate there to there. That's the room they needed to move. So if we take that over here, predict it down, there you go. Will be negative 4%. What that means, Mr. Bloxham said, is that Australian interest rates are set to stay at record low levels, or potentially go negative. Or if the bank's forecast for the interest rates on the 10-year government bonds holds true until at least 2025. What our team is suggesting is that actually we should expect that this is the state of the world that's going to be around for us for quite some time yet, he said, if global interest rates are going to stay low going forward for a number of years. HSBC's note to clients suggests that long-term real rates, which take inflation or rising prices into account, will be close to zero. Up until recently, Westpac has led calls for the Reserve Bank to bring the cash rate down from 1%, where it sits today, to 0.5%. Now, Deutsche Bank says it expects the cash rate to drop to just 0.25 percentage point by as early as the end of this year. Look, it's really hard, I think, to see an upside here, he said. You know, we're not going to go back to the kinds of interest rates we saw prior to 2008. Mr. Lowe faced a parliamentary hearing early this month. Labour MP Andrew Lee asked him what the Reserve Bank would consider looking at if the economy went further south. He replied, "We are prepared to do unconventional things if the circumstances warranted." But Mr. O'Dougall, I'm pronouncing that wrong, aren't I? Believes quantitative easing, where the Reserve Bank buys government and corporate bonds as a means of pumping money directly into the economy, is just a matter of time. Yes, and will that even work? Or will that just inflate the equities? At some point, you're going to see the RBA adopting unconventional policy, he said. Whether it's this cycle or not, who knows? So what does this mean for borrowers and homeowners? Certainly from the household perspective, the expectation should be that interest rates are going to stay low for a persistent period of time. Ms. Morris believes the reassurance is something Australian borrowers have never experienced before. It really is now telling people you do not have to worry about rates going up in the foreseeable future, she said. So pay off those mortgages, people, now. Hit the capital. And what guidance is obviously there to give that comfort, to provide people with the incentive to go out and borrow and feel like they're not going to be shocked by doing that. Ms. Morris also thinks that interest rates on fixed-term loans aren't going to go anywhere but down for years. Earlier this month, the Bank of South Australia slashed its interest rates on a range of fixed mortgages to below 3%. Well, I think I might call my bank now. The Bank of Melbourne and St. George also made cuts of more than 1%. Banks are themselves expecting that the cash rate is more likely to be going lower over the next 3 to 5 years than higher, and that's certainly the view that the bond market is expressing also, Ms. Morris said. Hardest hit by these extraordinary times, though, are low-wage earners who can't bag a pay rise and savers. And as Ms. Morrison points out, there's simply no end in sight to this economic funk. The reason why interest rates are going to be low or lower still is because of the economic backdrop, she said. Not just in Australia, but globally, which as the months have gone on this year is starting to look a little bit worse. So you have to keep that in the back of your mind too, that it's not a free ride in terms of interest rate cuts. The interest rate cuts are coming because of a softer economic backdrop. So is this just a roundabout way of saying we're heading to a recession? That's what I think it certainly is. And I'm not surprised. No mention of negative interest rates, though, in this article. No mention of that, of the potential for that, or that it even exists. Because while you can see here from another related article, where they're linking to, this is why the IMF wants to stop you from using cash, while the ABC is talking about it, you think it would be referenced in this piece as a potential. That seems like a truly unconventional method I pretty much feel like QE is pretty much done and dusted in a lot of countries now. Proven not to be very effective. Let me know what you think, guys. Like, share and subscribe, and I'll see you next time. Take care.